welcome back to the Real Estate Reserve Podcast. I'm Jason Balin from Hard Money Bankers, co-host Ian Horowitz from Equity Warehouse. Have a great guest and a great show lined up for everybody today. If this is your first time viewing, watching, listening to us, thanks. I promise we'll keep this show entertaining. Promise you're also going to learn something as well. If you're a return viewer, follower, watcher, supporter, thanks again. Certainly couldn't do it without you. In a second, we're going to bring on Brad Rice. Definitely looking forward to hearing his story. We talked to him for a second in the back room about some of the real estate companies he founded, including his most recent tech company in the real estate space as well. So I'm intrigued and looking forward to this one, Ian.
Yeah, I'm excited for it. I embarrassed myself earlier when we were talking before we hopped on. I was like, oh, yeah, I'm so-and-so. He's like, you're on my podcast. I was like, shit, I'm an idiot. So anyway, with that being said, I'm excited for this episode because we had really good conversation on his show with his business partner. But guys, if you get any value out of this, we don't care about the likes and the subscribes. What we care about is sharing it. It's the best compliment we can give our guests. Our guests are real people doing real deals. They're not gurus. They're not trying to sell you anything. They're just coming on here and telling you about their experiences. So if you get any value out of this, please share it. That's the best compliment we can give to our guests, and that's what we care about the most. And enough about us. And let's bring in Brad. What's up, brother? How you doing?
What's up, guys? Hey, if you're going to say you're excited to have me, you should look excited. Let's get some smiles going.
Yeah, dude. Listen, it's the East Coast right after lunch. We're a little sleepy out here. And you're on high alert. You got fires all around you out there in California. So different speed.
I mean, Ian, you own an energy drink called Buffed, and you're still not freaking hyped up, buddy.
Dude, I literally walked right in the door. I'm sat down. I was like, damn it, I need my energy drink, but it's all the way over there. So
that's Bucked Up. Is that what you're talking about?
No, Buffed energy.
Buffed.
Yeah,
I see it. There you go. All right, I'm gonna have to learn about that.
Yeah, we'll tell you all about it. But Brad, why don't you introduce yourself? You're out there in California, thank God, safe. And why don't you tell everybody who you are and what you do?
Yeah, thanks, bro. Appreciate that. And just real quick, I'd be remiss if I didn't say it for everybody that's affected by the fires. I feel for you, praying for you, and Godspeed to rebuilding and all that. I did lose a friend in the fire from high school, so this is the real deal out here. But yeah, super. Thanks for having me, guys. Look, I've been in the real estate game since the early 90s. So again, I'm Brad Rice. Live in Southern California. I started in real estate right outside of college in 1993 and didn't really know what I wanted to do, but I was buying my first house. There was a gal sitting across the table from me doing the loan application. I was like, this looks like something I could do. I'm good with numbers. Spent a day with her and I was hooked. So I got in the mortgage business and, from that point forward, I really found my calling. I grew my origination business as a frontline originator into a really big business. I was, by the end of the 90s, I was closing 40, 50 loans a month. I had a team of 5 people, and that led me to starting a company in 1999 and making that into a national company. And, that was the beginning of everything.
Yeah, that's crazy. A lot of the, I feel like a lot of our listeners and viewers, not that they're newer in real estate, because that's not a fair assessment, but last decade, 10 years, maybe 20 years. So, I mean, you can learn a lot from somebody who's been in the game for, that period of time. I mean, he's got about 10 extra years on me on, when I started getting into this. And, if you ever want knowledge from somebody, listen to what people have done in the past. That's the best way to learn. And, I think people take that for granted. They think they know everything, especially since we've been in such an appreciating real estate market over the last, since, I don't know, call it 2012. It's not always like this. Things change, right? We were in a low interest rate environment and we had a lot of appreciation. And even when, the interest rates increased, the value still increased with it. So funky things happen, but things change, and learning from the past and learning how 2007, 8, and 9 affected you guys, is a learning lesson that sometimes you can't even teach. You got to kind of experience it. And I saw that because we started in the early 2000s, and then we started our lending company in 2007, and we were lucky when we started our lending company. I mean, we didn't know that at the time, but we kind of started at the bottom. But I did own real estate, and I was involved in real estate, so I saw it. So, let's talk a little bit about how you grew your mortgage company as big as you did. It's obviously impressive.
Yeah, happy to. Look, what you said resonates, Jason. Everybody starting in a business, in an industry, in a career should really find a mentor, right? That is, if you want to expedite your ability to be successful, that's the one key ingredient, right? You could read, which is really helpful. You could learn that way. You can go online, you can watch videos. But if you have a mentor that's been there and done that, and basically you go in with a clean slate and they say, do X, Y, and Z, and you literally do it blindly, you're going to be successful, as successful as they were. So unfortunately, and this exists even for us in my company today, most people, even when they find a mentor, they don't really listen, or there's always an excuse why they don't do what they were asked to do, or, oh, my aunt got sick, or, there's always some excuse. I was not that. I was in my early 20s. I graduated college. I found a mentor at the first company that I worked for. He was about 15 years senior me, and he just told me what to do, and I blindly did it. And I will tell you, the absolute key to my success from the very beginning was starting with a CRM. And, for those that don't know what that is, it's a client relation management software. So this is where you have all your customers in there and you're able to communicate with them. But hey, can you imagine, Jason, back in 1993, what that might have looked like? It was DOS based. Okay. It was the GUI was DOS. And so, but it worked. By the way, the name of that product was called Telemagic. Look it up. The founder of that is known as the godfather of CRMs, and he actually still lives in San Diego. So I connected with him last year. But that being said, he said, start with a CRM, put everybody that you know in there by name or by face, grab your parents' phone book, and anybody that you grew up around and knows you, put them in there too. And I did that. And I spent probably the first 6 to 8 weeks just doing data entry. And I would call people and I would ask them to update me on their address. And, this wasn't even really during email. We didn't use email quite frequently at the time. So I didn't even have emails. This was phone numbers and addresses. And then he said, you're going to send them a mailer every month. And so I've been doing that for 30 years. I don't even originate loans anymore, but my database still gets a postcard every couple of months. Keeping in touch with people, letting them know what you do for a living, and reminding them. It doesn't even matter what you say in it, but reminding them that that's what you do, that's the key, right? And so anyway, I did that. I don't want to go too far down that rabbit hole.
That's a great story. Dude, that's I think a lot more valuable than people understand or people realize. And I did that too in the early 2000s. And my business partner, who was not my business partner, he was just a friend that, worked in the same industry at that point. We did the same thing. He came over to my condo because I bought a condo very shortly after college, and we would sit there and we would drink beer and lick freaking envelopes. I was big into Brian Buffini back then, and that was in essence maybe not my direct mentor because I was never in his highest level program at that point. But I bought his stuff and data entered everything, and then we would just lick envelopes every night, mail them. Because this is there's email, I guess, back then, but it wasn't like it is today. Today, it's easier.
Way easier. And by the way, you break through the noise today by getting in the mail the physical address. But it's funny you say that because I got married in 93 too. And so I started in this mortgage business. And one of the things about the mailers was I was doing, you may know what this is, but FHA and VA loans, but I was doing streamlines. So this was like a quick refinance. It's easier to refinance doing a streamline loan.
It's just your same clients over and over and over.
And I would get a list from the title company and do a mail merge and then print envelopes and go home to my bride. We were just married. I go home with a big box from the post office, those kind of clear boxes filled with letters that I would physically sign and envelopes. And the two of us would sit watching TV, stuffing envelopes, just like you described.
Yeah.
I didn't lick them all because I don't think I'd be able to open my mouth, but I did use a sponge, right?
Yeah. No, I think Jason's reason to drink more beer. That's all that was.
Oh yeah. That makes
No,
sense.
but I mean, I think that's where it is. And like today, that's evolved to social media marketing and email broadcast systems and higher level communication with texts and auto dialers and stuff like that. But no, I think that's a really good learning lesson, because even back in the day, like that's what we did. Like that was your marketing campaign.
Yeah. So that was a big part of it. I did that. I followed what my mentor said: build your database, send mailers out. I went and visited people in their homes and things of that nature, and that really kicked me off. So over the first decade, I began to hire people to help me, and I had a team of 5 people that was just crack. I built a conveyor belt where I could do what I was really good at, which was talking to people and taking loan applications and structuring loans. And I could structure a loan in my head while I'm doing my conversation with them. And then I would pass it off, and I would really be out of the process. They would everybody had their thing they needed to do, and they pushed it along the conveyor belt until we got it closed. That led me to start a company called Mortgage Corp of America in 1999. And by the way, I really never worked for anybody else. I never worked for another company. Even growing up, I delivered pizzas for like 3 weeks, but I was always an entrepreneur. I had a car detailing business. Like I always just did stuff. I was scrappy. I made money. And so even when I started my mortgage company, my learning came from people I knew. It came from mentors that had done that. And the structure, the corporate structure, the titles, what people did, having a CFO and all those things was really learned from hands-on from mentors that I had in various ways. So I grew this company. We were a juggernaut. We were nationwide. We did what we call wholesale and retail, meaning that we accepted business from brokers, and we also were consumer direct. And we even wrote our own mortgage product. I learned how to write mortgage product. I handled secondary. I worked directly with Wall Street selling loans. You ever seen the movie Big Short?
Of course.
Okay. So I lived that. And that movie's fairly accurate. Toward the latter part of the beginning of the 2000s, call it 2005, 2006, if you can remember back then, and for those that weren't alive or weren't in the business arena back then, what was happening was real estate was prices were going up exponentially, very fast. But it was driven up not from a lack of inventory like today or the last couple of years. It was driven up by greed. It was driven up by making it easier for people to get loans. So we would basically do loans in the 90s, the early 2000s, that Fannie Mae, Freddie Mac, FHA, VA would accept. We'd follow those guidelines. Then something came out called subprime. And all that really meant is you didn't meet those guidelines. We couldn't necessarily verify your income. Maybe you're self-employed. Maybe you just don't document it. You're making cash, things of that nature. So how can we get somebody like that qualified? So let's say Ian, has a landscaping company. Everybody's giving him $100 bill every week, and he's not putting it in the bank. He's putting it under his mattress. He could afford the house, but he couldn't get a loan. So let's find ways of doing loans for these people. So that's how it started, making it easier for people to qualify, doing things called stated income, not verifying it, but saying, Ian, what's your monthly income? Oh, it's $12,000 a month. Okay, write that on the application. That's acceptable. That literally is what it got down to. But then even worse than that, because what we were using to justify those loans when they started was good credit. We'd pull a credit, and this is when the beginning of credit scoring like FICO. And we'd say, okay, the likelihood of repayment is good because look how good his credit is. He's got depth of credit. He's got X number of lines of credit, and he's got high credit scores. Well, guess what? We ran through those loans. Wall Street needed more business. So what's the next step? Let's drop the credit scores. So now instead of a 740 needed or a 700 needed or a 680 needed, let's go 650. Not enough? Let's go 620. Not enough? How about 580? How about a bankruptcy yesterday and you can still get that loan? That's what we were doing. Now I'm going to take it a step further. This is the third straw that broke the camel's back, where we really hit this point where it was inevitable that the market was going to crash. Lower down payments. So initially we required skin in the game. Okay, Ian, you don't really qualify. You say you do, but let's just turn a blind eye to that. You're going to put 20% down. You're not going to let that go. That gives us insulation. Let's do it. Now let's go 10% down. How about 5? How about 0 down? So as you can see, guys, this is what happened. So I will just tell you, just to compare real quickly to the Big Short. If you go watch that movie, if you haven't seen it, I'm in Chicago in 2005 at a big convention, what we call NAM, the National Association of Mortgage Bankers. I'm sorry, MBA, Mortgage Bankers Association. That's what it was. At a decadent party. These are Wall Street investors that were involved in mortgages at the time. I won't name, well, I can name it. They're out of business. This one was a Bear Stearns party.
I know them all.
So Bear Stearns, Lehman Brothers, all those guys are gone now, but it was decadent. This thing was just, alcohol is flowing. It was just unbelievable. So, but this was an opportunity to meet with the traders that we were selling loans to. Now, mind you, that they're the ones that really were dictating what paper they wanted, what kind of loans they wanted, what they're willing to buy. And we're just providing them that. It wasn't us on the front line saying, hey, let's do loans at 0 down with a 500 credit score. It was them saying, we'll buy these loans. We want to buy them. And so, okay. So I'm standing there in this back room at this party with a floor manager, and we're waiting for the trader to come in. Trader comes in. He looks exactly like you'd picture a Wall Street guy, slick back hair, long overcoat. Like he's probably 26, 27 years old, maybe 28 at the most. We're talking, and I said, look, what are we going to do when the market prices even level out, let alone drop? All these loans are bad. Like, what are we going to do? The market's going to crash. This kid literally stood up from the table, slapped his hands down and said, if you don't like it, don't sell us loans. And he walked away. That was the mentality at the time. And I'm telling you, God's honest truth, that meeting took place. That's exactly what happened. The manager apologized to me, said he's a little hot-headed, and business went on. It was about 6 months later that the wheels started to come off the bus. And I wish I was smart enough to know how to short the market at the time. Didn't know. Anyway, that was the end of my company and many of my colleagues' company. I was negotiating selling my company at the time for very large money to basically almost bankrupt. And that was a reset for me. So that's the type of thing you can't teach in school. It's the type of thing you can't do anything but live through. But that experience I have imparted on lots of other people to help them to avoid similar things. I wish I held on to that company. I wish I had the wherewithal to have kept all the licensing and all the things I had built over that period of time. But for me, it was a very scary situation, and I just had to close it all down. And
yeah, and a few things to add. One big thing related to, I mean, that was a perfect story, and I mean, and hopefully people that didn't understand that resonated with that. But a big part also was, a lot of the loan terms were like 228s. So, think about like a 30-year fixed loan. Well, they would do something called like a 228, which was a 2-year fixed rate. And then it would be variable and it could adjust. And think about that. Like somebody's qualifying for a loan based on a less interest rate today.
That's right.
And we'll just figure it out in 2 years. Well, guess what? Those are all called notes because then they couldn't refinance or do whatever.
They couldn't afford it.
Yeah, they couldn't afford it. And I mean, I was in that industry for years as well before we started our hard money lending company, and I witnessed it as well. I mean, it wasn't my company, but
yeah, Jason, you'll remember also the pick a pay where you could go negative amortization. So not even covering the interest, you're paying a lower payment. Oh, I'll pay back later, and your loan balance continued to grow.
Exactly, and it based on they qualify for this, and then in the future the property value is going to increase. Everything was based on property values increasing, right. and then it was okay. So let's kind of stay in the same gear a little bit. So, what do you think the difference between today's market is compared to back then?
The paper's a lot better. So. The loans were way more sophisticated in qualifying people. There's way more data out there. The checks and balances, there's not as much fraud. Fraud still exists, but it's really minimized. But the paper is just a lot better. The inventory issue is what's driving prices up. There's just not enough homes for sale. What compounded that? Well, number one, Ever since the market crash, 2008, housing starts have not been where they need to be to keep up with population. What that means is that there's not enough builders building homes. They're not getting permits to build homes. They're not building enough homes. We've got a giant shortage for our population. The second thing is that what compounded this was in 2020 and 21 when rates hit 2%, 3%, even 3.5%. Nobody wants to get rid of those loans because if they get rid of those and move into another property, then they may want to do it. They may want to move, but they're going to triple their payment for a lesser home. And so those things have really caused a real big problem with inventory. And it's simple economics at that point. It is supply and demand. When there is less supply and more demand, home prices go up. And we're still doing that. Slowed down in some areas, but we're seeing, and honestly, the fires here and the wipeout of those homes is going to cause prices to go up even more demand.
Yeah. And that's could be similar to some stuff in Florida as well. There's some natural disasters that's happened there. And here's the confusing part. And I think it's challenging for a lot of folks to think nationally and because things do differ in different markets. And I think our mid-Atlantic market on the East Coast is probably similar to your market. It's not like we're in Midwest and there's very little population. There's a major market. And the challenging thing for, I think, a lot of folks, and even me when I think about this stuff, is affordability for folks. I remember when I bought my first condo, like I paid, over $300,000 for my first condo, and it was very hard to afford that, right? Like, did I have to get a cosigner? Do I have to get, borrow money from somebody to help with the down payment? It's a lot of money. And like things are significantly higher today than they were in 2002. So that's always hard for me to wrap my brain around, is like, hey, if these property values continue to go up and go up and go up, it's squeezing out, and just making it more affordable for folks. There's only so much that they can, that they can afford. So that's where, I go back and forth, and as a lender, who's lending my own money out on these deals, I always think we're at the top of the market, and I'm cautious. And I've felt like we've been there for the last 10 years. And I think a lot of folks do. And then it continues to increase. And then, COVID hits. It's like, this is it. Market's crashing. And then they double in value. There's no way to kind of determine that. It's just at some point, and I agree with you that there's a lack of housing and there's no inventory because, think about it. In any one of our neighborhoods, we're used to having, a few houses on the market all the time. And hey, I don't like this one, I'll go look at this one. I don't like this one, I'll look at this one. Now there's one property that always comes in the market and then it sells immediately. And it sells for more than the last one. So it's a challenge.
Jason, I'll tell you this. What you're saying, I think a lot of us think and feel, especially if you're in an area, like I am, where the median price is so extraordinarily high. When I bought my first house, Fannie Mae, Freddie Mac loan limits were $117,000. Okay. Now they're over $1 million. They're $1.2 million. They're $1.3 million. So, I think every generation has that same feeling. Like, but also it's all relative and it's all about inflation. So, when I first started to drive when I was 16, the price of gas was 65 cents a gallon. Now we pay, at some places here right now in California, it's still in the sevens per gallon. So, but people are buying gas. And so it is part of that's inflation. And so I would tell you, after 3 decades of being in real estate, it's a flaw to think that it won't be worth more in the future. It's like thinking the S&P will go down over time. It's consistently gone up decade upon decade upon decade. So that house today, depending on where you live and where you're listening to this, that you're thinking is top of the market, another decade, maybe 15 years, is probably going to be double that. It's inconceivable today to think that that's the case.
Yep.
But thinking long-term, as a long-term investor in real estate, you could almost bet the bank that that's what's going to happen. And all you have to do is look back over the last 60 years.
Yeah. And I would say for us, like, our best performing assets are the stuff that we've owned for 10 years, right? Because our debt's been locked in for so long. Yep. We have long-term amortizing debt. It's not resetting every 5 years. and keeping up, right? So if you can get the right loan products on your single family properties or even commercial real estate, I agree with you 100%. Most people can't withstand the bumps and the bruises and the headaches it takes to own and operate real estate. And look, I go through it too. There's some days, fuck it, sell everything. And then there's other days, this is the best asset class ever. I'm never selling anything, right? Like, you got to be willing to stay the course. And I think, at least with real estate, it is very illiquid and it allows you to own for a longer period of time. It's so easy nowadays to literally go on and sell a stock or sell Bitcoin or sell any, like, I don't like this today, or I need money. I feel like at least real estate, it's so illiquid. It takes a lot of work to sell that asset that I think it helps you stay in a little bit longer. Funny though, my learning lesson from 2024 is literally sell everything and keep the velocity of capital going. But I do agree with you over the long period of time that they will be worth more. Just, I think it depends what market you're in and what type of assets you're buying. If you're buying in the heart of West Baltimore, they might only go up by 1% in that 20-year time horizon, where Southern Cal, Philly, Maryland, DC submarkets, we're talking, 3% a year. Right. Yeah. And I think that's the big difference, that people need to really think about that long term and paying that debt off side by side with that it's a really nice savings account.
And that's a really good point. And this is, I think, ties into what we talked about at the beginning with mentorship. Tapping into somebody that's been doing it longer than you. I've been in the game 30 years. I talked to somebody who's been in it for 50 years. This is where, had I had the wherewithal, not going through that, oh man, I got to sell everything. I got to do, not going through that because you have a mentor telling you, just hang on, trust me, just hang on, and putting that faith and trust in them, we'd all have been a lot better. So, I think that it is tough to conceive of values doubling and tripling from where they are today, but trust me and trust the people that have been there before, it will. And so, that's my lesson. I don't sell properties anymore. I acquire and I don't sell. I keep them long-term. For whatever it's worth, I've never had the bandwidth to really learn short-term rentals. I've interviewed a lot of people that do Airbnb, short-term rentals. I'm invested in some LLPs where we do that. But as far as an operator is concerned, I've just never, taken that learning curve on. And so mine are not that. They're commercial and they're residential and multifamily, but they're long-term hold. And I'll tell you what, if I didn't do that, I would have never made it through the crash of 2008, because that was almost a complete wipeout for me, with the exception of saving my personal properties.
Yeah, that's actually interesting. And something that Jason and I talk a lot about is taking your active income, applying it to quote unquote passive assets, right? Even though real estate's not passive, but it's passive in the sense that you're moving that money over and you're putting it into something that's going to save you. So, you go through 08, it's probably 2007, you probably started to see it 2006, and it probably lasts till 2010, 11, maybe 12 for you, if I had to guess.
Yep.
You mentioned that rental properties got you through there. Talk us through what got you through, and then what happens on the other side to get you back in the game.
That's awesome. Good segue. You're exactly right. It did take till about 2012. During that period of time, Ian, I tried everything to get out of mortgage. I thought I went into franchising. I went into credit repair. I went into all these other things. And then I realized mortgage is in my blood. So I got sucked back in. So, that being said, I'm going to kind of, because, we've kind of gone real deep on some of these things. I'm going to stream us through this. Got back into mortgage, believe it or not, started originating loans again. That was a learning curve, because things had changed so much with Dodd-Frank Act and all the ways to disclose mortgages now, and the restrictions and regulations and pricing and all that sort of thing. I had to relearn it, which I did. And about a year and a half later, I took an old corporation that was on ICE, that was a real estate brokerage I had, converted to a mortgage company, and that's what is today, which is AmeriFund Home Loans. And today we're doing pretty good. We're for a tough market for the last couple of years, we've expanded. We're in 32 states, so we're almost national, and we've got a really good platform. I have a business partner. She's been with me for 25 years. She was with me through the growth of the previous company. And she is a godsend because she really runs the day-to-day of that organization. What that enabled me to do was start something that I currently have a real big passion for, and it is the intersection of technology and real estate. And what it is, it's called Homepie. And this is for the best short description, it's a for sale by owner platform. So it allows people to sell their own property using technology without the expense of a real estate agent and the commissions. Okay. I'll tell you where this was born. Because my mortgage business was primarily consumer direct, there were a lot of people that we helped that did not have a real estate agent. And it always was in the back of my head. It's like, how do these people make the decision to sell their own property? And how are they so confident in getting that done? And so I started to really research that. And I realized was for decades, that market, the agentless market, was about 10% of the market. Now that includes home builders that don't have an agent involved in the transaction and so forth, but giant beachhead market. I'll put it in perspective. The largest percentage any one real estate brokerage controlled was in 2021, it was 4% of the market. Okay. So a 10% beachhead market is huge. But I also realized that from interviewing these people, where things were lacking was exposure to their properties, number one, and number two, making sure that they're confident in going through the process so they're not missing something. The paperwork, the uncomfortable process of negotiating, getting all those terms into the contract, those were the things they were missing. So I said, you know what? Technology's come a long way. This is in 2019. I said, it's come a long way. I bet you I could build something that's like TurboTax, that what it did for creating complicated tax returns in a step-by-step format for real estate. And that's what I did. And so with Homepie, you can spin up a listing as easy as you could spin up selling a baby stroller on Facebook Marketplace. Seriously. And not only that, you can upload photos. You can, it's a marketplace that you can surf and save and share and all those things you do on Zillow and Redfin and Realtor and all that. That's table stakes. But what happens is, as a buyer, you can search for those properties. When you find the property you like, you can contact the seller directly. You can take a tour either virtually or schedule something in person. But when you've decided that's a house you want to write an offer on, the technology drives you through that process step by step. Every term that goes into a traditional offer is built into the process. How much you looking to offer? How much down payment? Do you want a loan contingency, an appraisal contingency, an inspection contingency? Do you want a contingency to sell your house before you buy this? Everything that goes into that. Anybody that's gone through a real estate transaction knows what I'm talking about. In real time, the seller gets a notification and then goes in and can accept, counter, or decline each of those terms. That process goes back and forth until they're all agreed to, and then it produces one clean agreement that gets signed. That is our proprietary standout technology. It has made it easy for anybody to sell their own home. We're still at the infant stages, meaning there's a lot more growth that we're doing. We're bringing in third-party vendors to help complete the process and all of that. But I'll tell you what, there's no way I could have predicted that I would have regulatory tailwinds today when I started this thing. So the NAR settlements, the class action lawsuits, the DOJ, the clear cooperation disclosure, all these things that are going on, they all play in the hands of disruption to real estate. And we've got 4 years on everybody, and we've refactored, retooled the site. We're ready to explode. And I've decided this is the year that we raise money. We do that.
So that's awesome. Yeah, I've been messing with the site as you've been talking, and it's pretty impressive. So the only let's say you're a buyer, the only listings that are on the property are people that have, in essence, used Homepie. Is there also MLS listings that are
strictly FSBO listings? We don't bring in MLS. We don't have agent listings in there. So you can go to Zillow, you can go to Redfin, Realtor, Homes.com. You can find all the agent listings today. Who knows if that's going to be in the future? But you want to find homes that are for sale by owner, come to Homepie.
Got it. Got it.
And real quick, the case use that you said when we were talking about this early before we all hopped on was you got home flippers that are popping it on there. They're saving 3 to 6%. Maybe long-term holders of real estate, screw it. I'll find an investor on here. Would you say it's predominantly more investors on your site and home flippers, or is it you're seeing a cross gamut of literally everybody?
It's predominantly people that I'll tell you the disposition, because I talk to a lot of these sellers that come on the site. I like to jump in and kind of hear their stories and that sort of thing. It's people, number one, that feel the last transaction they did that they have a real estate agent, they paid way more than what the value was. And maybe it's somebody that sold when the market was robust, and the agent went online and bragged about how they had 15 offers in 2 days and they sold it for above list. Well, that was not them. That was the market doing the market, right? And so they're like, shoot, I paid $60,000 and all they did was put this on the MLS. So it's people like that. It's people that need the money out of their home to do the next thing, to either invest in the next property. They can't afford to pay the extra 10 grand or 15 grand in fees. They really need it. Or they need it for their kids' school, things of that nature. So there's a need factor, right? And then there's the people that just hate real estate agents. It's very interesting. And by the way, my son's a real estate agent. I have many friends that are real estate agents. My head of product was my real estate agent when I bought multiple properties. So I think real estate agents are fantastic. They're never going away. The problem is 95% of them suck. And your good agents will tell you that. And it's frustrating, and they don't call people back, and they don't follow through, and they cause problems during the transaction. They create panic, all those things. And your good agents will say the exact same thing. I have agents on my cap table invested in Homepie, great agents that know that they're not going away. Personally, their business isn't going away because they work with people that value money more than time. But most people value time more than money. So if they knew they had a vehicle to sell their property and save the money, they would do it. Most people don't know they can do it.
Got it.
Yeah.
I mean, that's a good shtick too, because like you're not bashing real estate agents. It's like, hey, there's two sides. If you want to pay a real estate agent to provide you value, that's a good way to do it. But if you
for sure, hey,
don't want a real estate agent, or there's not enough room, there's not enough equity to sell the property, this is a good option as well. And
especially in a down market. But I'll tell you what, Jason, I still use a travel agent.
Yeah,
I don't have the time. My assistant's not great at it to do my travel plan. I use a travel agent. They didn't go away, but the good ones are still there, and they still have clients that value that service. And I don't think it's going to shrink to that level. That's not what I'm predicting. But I do think that the 10% beachhead market becomes 20 to 25% that feel they could do it on their own. And we just use technology and AI to walk them through the process. And it's not as complicated as you think if you have the confidence to do it.
Yeah. I was going to just say, I'm glad.
I left you speechless.
No, I'm just glad both of you spoke up, because I was going to bash real estate agents, because I agree. Most of them suck, but they're the good ones. Most of the good ones are good, and they do provide service. They do provide value, because you don't want to go through the headaches. There is a lot of bullet points to the transaction, but then side by side with it, like I just sold a house, and this is probably not your primary market, but it's a rental property we owned, and we got 125 grand, and it's like all this bullshit, and I still had to pay the guy, and I did most of the work. It's like you could have just put it on your site, been done with it, and still did all the goddamn work. So I agree with you, and it's interesting.
I'm going to say something a little contrary to what most people think, especially with these lawsuits and so forth. My belief, and I've said this so many times, is that buyer's agents bring so much more value than listing agents. Okay. And I'm going to tell you why. And again, it's not bashing listing agents. There are people that value their money more than time, and their time more than money, and they're going to hire agents. I for one, I've sold all my properties. I bought all my properties. I use agents to help me through the process, so I don't have to spend all my time doing it, but I could do it from start to finish. Here's the deal. If you're looking at property in an area you don't know, so let's say you get sick and tired of where you're living, and now you're going to move to Southern California because you just love fires, but you don't know where you're going to move, you need a local expert that's going to tell you, no, that's not really where you want to live on that side of the street, because here's what happens over there. You really want to be in this neighborhood. Or, let's say you've got kids that are 10 and 12. You're like, I really want to be in a neighborhood that, have kids. You're not going to know that by looking online. Not today, anyway. You're not going to know that. And so you need that local expert. So a lot of that is happening. People are jockeying states, they're moving. They're, what is it? 1.4 million people over the last 4 years moved out of California. If I want to move to Tennessee, I either have to have a friend there that's going to explain everything to me, or I need to hire an agent, right? Yeah. And so we've invited buyers agents into Homepie. They can create accounts. They can connect with their buyers. They can invite their buyers, or vice versa. Buyer can invite them. And they walk them through the entire transaction. And then the buyer just does the signatures. So we have embraced the buyer side. And here's what we've done for them. For those agents, we've unlocked inventory that traditionally hates agents and don't want to work with them. If you, as an agent, call a for sale by owner that's not on Homepie, they typically want to blow you off because they're like, I'm not paying you. But when you make it easy for them to bring in their buyer, and you explain to sellers that they should be looking at every offer, whether it's agent represented or not, and just pick the best one, we've unlocked that inventory. So we're actually very agent friendly on that side of it.
Yeah, it's good to hear. It's good to know, because a lot of people do these things to say, let me block them out. I don't want to deal with that, and everything else. So it's good that you've embraced that. And I think there's good case uses, and it'll be interesting to see what happens with the lawsuits from the NAR stuff and everything else, and where that ends up, and, political changes and everything else. You never know what's going to happen. You don't know what's going to happen tomorrow. So that's really good to see that you're embracing that. Dude, you've had quite the story. I've enjoyed it. I mean, if you notice, we take notes behind the scenes. I'm like, Jason, this is like, I'm locked in, because I always talk about Big Short. It's a great movie. It's great to hear your perspective, someone who lived it and worked all the way through it, who had a company and then actually lost it. And here you are today, back on your feet, grinding away, making a ton of money. So it's been awesome. When you're not doing real estate, what's your go-to hobby? What do you enjoy doing in your free time?
Well, I'm really into fitness. I work out almost every day, weightlifting and all that. I do that a lot with my son. So if you're on my socials, you'll see some posts with me and him together. I want to say he's my mini me, but he's not really mini. I think he's past me at this point. He's 28. But yeah, we work out together, and then I've got a house on a private lake, and we do a lot of wake surfing and good summer stuff. Water sports are my thing.
I like that. That's we enjoy that too. Water oriented is always fun. And then before we go, I had to ask that just because I do know your socials and I saw the pictures, and weightlifting is always good. But we do like to ask everyone, what's one book or podcast that you enjoy listening, or you think everybody should go check out?
Look, I'll tell you what, I love the variety and the messaging that Gary Vee puts out. And I could name a lot of other people that I really do like, and I listen to their podcast. But I think there's something really interesting about his approach to really talk to people at different genres, different periods of time in their life, different age groups, and really gets through to them. He's got a knack for it. He's got a talent. He was born to do that. And, at least 15% of what he puts out there really gets through to me. And so that's what I would say is Gary.
Yeah, we were just talking about him this morning. Man's the OG of grinding. Where's the best place people can find you? They want to learn more about what you and your companies are doing, Homepie, Amerifund, or they just want to check you out on the social medias doing fun things? Yeah,
for sure. Look, the main place is you could go to thebradrice.com, and then there's a link to everything from there, my link tree and all that. But, homepie.com, HOMEPIE.com is the FSBO platform. Amerifund, AMERIFUND.com is my mortgage company. And then all my socials are at the Brad Rice everywhere on all platforms.
Right on. We'll get them loaded into the show notes. We appreciate you coming on. It was a really fun story. Guys, if you got any value out of this, I'll make sure I smile as I say bye to Brad. Brad was an awesome guest. If you got any value out of this, please share the show. That's the best compliment we can give him. And we will catch you guys on the next one.
Thanks for tuning in to the Real Estate Reserve podcast. Do us a favor and like, comment, and share our broadcast. It helps the algorithm and helps us spread the word too. Till next time, thank you for tuning in.